Good morning and happy Sunday. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, September 8th, 2024. Today I'll be talking about what Asbury Research's latest data-driven market research and quantitative models are saying about current financial market conditions. Specifically, when to be on offense and looking for opportunities, and also when to be playing defense and protecting your capital, protecting your money. What makes us different is we're not predicting what the Fed might do, speculating about how the presidential election might affect markets, or forecasting where the S&P 500 may be at the end of the year. Nobody knows any of this ahead of time, and especially doesn't know how any of these factors might affect future market direction. We just follow the money, follow the data, because the money never lies. The movement of money is what really drives prices and is the most sensitive indication of the changes in market opinion that ultimately change market direction. Asbury Research is a registered investment advisor, or RIA, and has been providing both investment research and money management to individual and professional investors since 2005. To get more information about us, visit asburyresearch.com and click the Contact tab, which you can find by hovering over About here and scrolling down to Contact, or you can simply click the link in the description of this video. Finally, if these YouTube videos are useful to you, please like and subscribe. Let's begin with a couple of fast announcements. Number one, Asbury Research recently added a new asset management tab to asburyresearch.com, and we have that right here. We have created three model portfolios. We have Asbury Aggressive, Asbury Balanced, and Asbury Conservative that utilize different combinations of our own data-driven models to produce different back-tested results. All of these portfolios have shown exceptional risk-adjusted performance, which measures an investment's return relative to the amount of risk it took to achieve that return. Contact us via the Contact tab to request PDFs with further information on some of the details and charts of these three new model portfolios. We have also recently launched a new free Substack newsletter that publishes one free chart per week taken from one of Asbury Research's premium reports. And you can see that right here. It's asburyresearch.substack.com. There's also an option to upgrade via Substack and get more charts from us. Our Substack offering is a low-cost option for entry-level investors that have found our premium research product, which contains all of our models and direct analyst access, to be prohibitive. Next, I will be the featured guest on the Schwab Network's Morning Trade Live on Wednesday, 9/18. It's about 10 days from now at approximately 9:15 a.m. Central Time. We'll be talking about the stock market's downside risks in September and October and how that folds into what our models are telling us. Now let's follow the money by identifying our key areas of focus as we look towards the fall and the upcoming presidential election in early November. First of all, tactical direction. The Asbury 6 shifted to negative status as of the close on Friday. Here is our Asbury 6. We're going to go find it right here. It's right at the top of the research center. And you can see here that 5 of the Asbury 6 constituent metrics are now red. What does that mean? It means that the market is now internally weak and it's vulnerable to further weakness. The Asbury 6 is our daily updated risk management model that looks beyond the day-to-day volatility and noise of the stock market to determine its actual health. We view the A6 as a lie detector test for the market that helps investors to identify real, sustainable market advances or market declines from the computer-driven traps for investors that we see seemingly every other day now, where the market's up 50 in the morning and it's down 50 in the afternoon. According to our historical backtesting, the A6 has slightly outperformed the S&P 500 over the past 7 years, but with just a 13.6% maximum drawdown versus a 33.9% max drawdown for the S&P 500. Lower drawdowns mean that you can recapture your losses a lot faster and start to make money again. Make sure you read the disclosures at the end of this video that pertain to hypothetical backtesting. Past performance does not equal future performance. The next thing we're going to look at is sector rotation via our CEF model. Our CEF model is also located right here in the research center. You can see it's right here underneath the Asbury 6. But what we want to look at today is we want to look at the financial sector. CEF remains on an August 19th long/overweight in the financial sector, which is XLF is the ticker for the ETF, and since then has outperformed the S&P 500 by 4.2%. Let's take a look at that chart. These are called rainbow charts, and these are the corresponding charts to the CEF model. There's one of these charts every week for all of the 11 sectors in the S&P 500. And what this chart shows, up on the top here is the CEF ranking daily going back for one full year. And you can see we've broken it down into three categories: favored, neutral, and avoid. So we have favored being green, neutral yellow, and avoid is red. And what we see here is since July the 2nd, there's been a couple of small breaks in here, in and out. You can see one in July 10th and another one in August 6th where it slightly dipped into neutral territory. But since July the 2nd, it's, for all practical purposes, it stayed in favored status according to the CEF model. And down here is the corresponding relative performance chart of XLF versus SPY. And you could see once we went into favored territory, we've got 11% of relative outperformance by XLF. I can also tell you that consumer staples, utilities, real estate, and healthcare have also been sectors that have been highly ranked by the CEF model during the past 1 to 2 months. They've been churning a little bit and moving in and out of the top three. The top three rankings for CEF is where we get our signals that we follow. But those four sectors are sectors that we're watching, and you should watch them too. The CEF model is a completely data-driven sector rotation model. The CEF model was created to quantitatively identify long overweight opportunities in U.S. markets sectors by following the money as it moves around the 11 sector spiders, which if you put them together, it's the S&P 500. The CEF model is always fully invested in the market, providing investors with a dynamic alternative to the traditional buy and hold portion of your portfolio. You can learn more about all of our models, including charts and backtested performance tables, by visiting asburyresearch.com and going right here over to models, which is the third one over. Hover your mouse over models, and you can go right down to each of these, and you can see some backtested performance data. The next thing we're going to look at is the last time I was with you 2 weeks ago, we talked about some of our Asbury ETF trade ideas. You can see that's another one of the 6 rectangles at the top of our research center. The one that we looked at and talked about was KAI. We signaled a buying opportunity in the it's the Spider S&P Insurance ETF, KIE. So we're going to go over to KAI right now and have a look at that. Here is where we put our signal on. Right here, the white arrow here, this was H6. Basically, we had a nice long trend. We had a sideways move, and then we had a breakout and a retest. We bought the retest, and we bought that really for four reasons. We look at 4 criteria when we're looking for these individual trade ideas. We're looking for a positive trend. We're looking for relative outperformance versus the S&P 500. You can see we've had that down here. This is KIE relative to SPY on a daily basis. This is the corresponding relative performance chart to the outright chart that we're seeing up here. We also look for expanding asset flows. We want to see the AUM in CHI expanding. And finally, the fourth thing that we look at is risk reward. We want to make sure when we're putting these trades on that we're either sitting on a support level or we've broken out and we've got something to lean on as we put our trade on. And you can see that we had that. We're leaning right on the 50-day moving average here and on the top of this rectangular pattern. The reason I'm bringing it up with you today is we got out of that trade on Friday. So we got out on Friday. We captured 7% here on the upside, while we also captured, I believe it was 3% relative outperformance. It is. We captured 3% of our performance. So we're constantly adding new ideas. If you're a premium subscriber, you just need to go over to the research center and monitor that. And the new trades will be there as we see them. The next thing that I want to talk to you about today is I want to give you some support levels. This is from our weekly wrap-up, which is one of the standard reports that we put out for our clients, for our subscribers. And this is the S&P 500 through the end of the week. So what we wanted to point out was 5505 was an important support level for us. It's the 50-day moving average. It's a minor trend proxy. It basically defines the minor trend. I don't think you can turn on CNBC for more than 10 minutes and not have somebody talking about the 50-day moving average. So we broke through there. That means the minor trend has turned down. We are in a corrective period right now, and the Asbury 6 is telling us that because the Asbury 6 switched to red or switched to negative status as of the close on Friday. Our next support level that we want to watch is 53.84. There are some minor highs and lows here that I think are important. I would look at this more as a speed bump than any kind of a major support. The big level that we want to keep an eye on is down here. 51.48 is the 200-day moving average. It's the major trend proxy. It's been closely defining the major uptrend in the S&P 500 from early in 2023. And then we've got 51.19, which is the benchmark low from August the 5th. That's about 5% below where we are right now or where we finished the week on Friday. What I'm interested in doing is keeping a very close eye on our Asbury 6. As long as the Asbury 6 stays in negative status, the market remains internally weak, and it could go quite a bit lower from here. If we get down to this 51.50 to 51.20 area, let's call it, over the next couple of weeks, and seasonality is going to be very weak now here through the second half of October, I should say, or through the first half of October, about October 15th, and we get down here and our Asbury 6 turns back to green, that's important to me. That tells me that by avoiding all of this downside, the ability to put our longs back on 5-6% underneath the market, it's a game changer. It's the kind of move that makes your year. So finally, let's just take a quick look at, let's go back here. Let's just take a fast look at the economic calendar for next week. There's a couple of important things that you need to pay attention to. They could be market movers. They both have to do with inflation. On Wednesday, August CPI. 7:30 a.m. Central Time. The year-over-year expectations of the market are 2.6% versus 2.9% last month. That was the data for July. And then on Thursday, we've got the August PPI, which is the really the other side of CPI. It's consumer is CPI and producer is the PPI. Also at 7:30 on Thursday, the previous reading for this, or the previous data point for this in July, year over year was 3.3%. So there it is. That wraps up another Asbury Research Following the Money podcast for this week. Our next Following the Money podcast is tentatively scheduled for Sunday, September 22nd. If you like our approach to investing, we can help you with either data-driven research or money management that implements my 40-plus years of experience in the financial markets and our own data-driven models. Request more information by going to asburyresearch.com and clicking the Contact tab. Hope to see you again here soon, and please don't forget to like and subscribe. Have a great week.